Welcome, everyone. Thank you for joining me today. I am excited to talk to you about some very important changes that could impact your financial future. Having a new tax law isn't surprising. Most of us expected something to happen with the pending expiration of the Tax Cuts and Jobs Act. But with the new law, of course, comes its own challenges and opportunities. So on July 4th, 2025, a brand new tax law called the One Big Beautiful Bill was signed into law, and it is one of the biggest tax changes we've seen in several years, more specifically going back to the 2017 Tax Cuts and Jobs Act, which we've been under since 2018, but it was set to expire at the end of this year. So today, my goal is very simple. I want to help you understand what's in the new law, what it means for you and your retirement, and steps you may want to consider as you start planning ahead. As always, just have a little bit of quick housekeeping to go through here. Just make sure we understand that this presentation is for education and informational purposes only. It is not investment advice. It's not legal advice. It is not tax advice. I always want to encourage you to meet or talk with your own financial advisor, attorney, CPA about your personal situation, because everybody's situation is different, and the right approach for you may not be the right one for someone else. If you don't have those professionals on your team at this point, or if you are looking for a second opinion, I'll share how we might be able to help as we wrap up our presentation this evening. And then lastly, again, we will have time for questions, but I'm going to hold those to the end. But feel free, again, to go ahead and put those in the Q&A as we go so you don't forget them, number one. And we'll get through as many of those as we can with the time that we have remaining. So let's go ahead and get started. I just want to share a little bit about myself. Again, my name is Eric Blake. Most of you may be familiar with me either through our email newsletter. I know we have clients who have joined us as well, but also through the podcast, any number of ways that you may be familiar with me. But if not, again, my name is Eric Blake. Our firm, Blake Wealth Management, focuses on helping women over 55 who've gone through divorce, been widowed, or just maybe navigating retirement on their own. That's our specialty, but don't worry, this presentation is for everyone. So if there are any men in the audience, couples who may be tuning in together, I promise you're going to walk away with practical, valuable strategies tonight. And that focus on women does come from my own story. I was raised by a single mother, spent a lot of time with my grandmother who was widowed at the age of 62. She is now 90. We actually have 5 generations of women in our family, with my granddaughter just turning 19 months old a couple of weeks ago. But it was really watching my mom and my grandmother navigate life and money on their own that really shaped how I approach retirement planning. And it's why I'm so passionate about helping people feel more confident about their financial future, no matter what their background may be. All right, so enough about me. So let's start by setting the stage here. With this new tax, we're going to talk about what the new tax law is all about and why it's so important to begin planning now. So let's start why all this matters. So in May of 2025, the House passed what's now being called the One Big Beautiful Bill, a sweeping tax reform package that touched nearly every area of our financial life: retirement, income taxes, estate planning, even your grandkids' education savings. Then after some negotiations, revisions, some late night votes, all this good stuff that we see in politics, it was signed into law again July 4th, 2025. And again, less than 2 months from that. And so it may still feel very recent, but the truth is now is the time to start planning. This isn't one of those laws that just sits quietly there for years. There are some of these changes that are already in effect, others that are time sensitive or temporary. And the way you respond in 2025 and 2026 could set the tone for your tax bill and retirement income for the next 10, even 20 years. So again, it's very important to understand how some of these things are going to impact you directly. So here's just the high-level overview first. So this law makes the 2017 Trump tax cuts permanent, which on the sounds just kind of like business as usual, but the fine print's going to reveal a little bit more than that. We also now have new deductions, especially for families and seniors, new types of savings accounts for children, even some temporary relief measures for workers. At the same time, the law attempts to reduce some of the spending in some other areas and shift where the government allocates resources. So again, it's just not about where you're saving. It's also about what you may lose access to in some of the years ahead. Now, here's one of the most confusing things about the tax law, and that's figuring out which parts are permanent and which parts expire. Some parts of the new bill are permanent, like these lower income tax rates and the extension of the alternative minimum tax relief. Others are going to be more limited time offers. So for example, the tax relief on tip income and overtime, only available through 2028. And we're going to walk through both types of these today, so you're not caught off guard when certain provisions start or when they end. It's this mix of temporary and permanent changes that creates both opportunities and traps. So you want to know where your window is and you want to act before it closes. All right, so now we touched on the big picture. Now we want to dig into how this law impacts individual taxpayers, especially retirees and those that are preparing for retirement. So first, let's talk about the income tax rates. So one of the biggest takeaways from the new law is that the lower brackets that were introduced back in 2017 under the Tax Cuts and Jobs Act are now permanent. And this matters because those lower rates were originally set to expire at the end of 2025. Without this new law, many of you, especially those with retirement income from IRAs or pensions, investments, could have seen your tax rate automatically increase in 2026. But now this gives us a little bit more predictability in your long-term planning. So it is essential that you work with your advisor, with your tax professional, to understand where your income falls on the tax bracket ladder, especially if you're doing Roth conversions or you're taking distributions from different types of investment accounts and retirement accounts. Now, another positive for retirees is the increase in the standard deduction. So for joint filers, the deduction is going to go from $29,200 for 2025. It's now going to be $31,500, and for single filers, it's $15,750. And then for those that are 65 or older and taking the standard deduction, you're still going to receive an additional $1,600 per eligible spouse or $2,000 for an individual. This does not include the new age 65 plus bonus deduction that we'll discuss next. This is, again, just a simple way to reduce your taxable income without needing to itemize. And then remember, for many of you, especially if you're widowed or divorced and you may be filing single now, this decrease can also offer some modest tax relief in your situation as well. Now, this is the big one. So especially for those that are 65 and older and living off retirement income, there is now an extra $6,000 deduction available if your income was under $75,000 as a single filer or $150,000 for joint filers. And if you qualify, this is layered on top of that standard deduction or your itemized deductions should you itemize. And again, it's a meaningful benefit, especially if you're managing taxes on Social Security and withdrawals from traditional IRAs or 401ks. Now, here's a big thing though. This bonus does phase out. So if your income creeps above those thresholds, you may find yourself losing some or all of those benefits. So planning ahead can really help you stay under that line. Again, this is beginning this year in 2025 and only goes through 2028. So you understand these windows of time. Now, this is often one that flies under the radar, but for higher income households, especially those with investments, stock options, large deductions, the alternative minimum tax, or what's called AMT for many cases, has always been something to watch. The good news is that higher AMT exemption levels introduced in 2017 have also now been made permanent. So this means fewer people are likely to be hit with AMT unexpectedly in retirement. But again, it's something your tax advisor should be running in your year-end projections, especially if you're looking at selling property or exercising stock options. But now, beyond the individual tax rates and deductions, the law also includes changes that affect families, parents, grandparents, even newborns. So I'll take a look at these too. So if you have children or grandchildren under age 17, or you support younger family members, this slide can really matter because the child tax credit has been temporarily increased to $2,200 per qualifying child, up from $2,000. And there are a couple of things you want to be aware of with this. The child must have a valid Social Security number. And number two, this increase is temporary. It only applies through 2028, and then it's going to revert back to the old amounts. So for working or caregiving grandparents, raising grandchildren, this could offer some additional support. And it may also improve your refund, of course, if your adjusted gross income falls below the income limits. Now, here's one of the more unique and controversial provisions in the bill. What are these so-called Trump accounts? And these accounts apply only to newborns starting in 2025 and are designed to help families save for the child's future. So I just want to go through a couple of the provisions here. Each newborn receives a $1,000 federal deposit automatically, and parents can contribute up to $5,000 per year after tax. And these funds can be used for education, job training, or first home starting at age 18, or for anything after age 30. So again, while this doesn't directly benefit those of us that may be in retirement, it can be a powerful intergenerational planning tool as well. So if your child or grandchild born in 2025 or later, this is something to explore, and contributions could be a meaningful legacy gift, especially if you're already planning charitable giving or gifting strategies. Now, for families, these changes may offer some short-term help, higher refunds for the larger tax credit, extra support for newborns through these new accounts. But again, keep in mind the child tax credit expires in 2028. The newborn account program also ends in 2028, and pretty strict rules around both of these programs. But that means families will need to plan ahead so they don't rely on these benefits that may soon disappear. So now let's get a little bit more into the details as far as retiree, senior planning, retirement planning, and how some of these provisions could impact you. So we're going to take a little bit deeper look at the $6,000 senior deduction for those 65 and older, possible impacts on Social Security benefits, and how Medicare premiums are taxed. We're also going to talk about some planning strategies for retirees like Roth conversions, timing of portfolio withdrawals, Social Security decisions, managing required distributions. Each of these changes can make a difference in retirement income planning, so it's important that we take a closer look at how these may apply to your situation. All right, so let's get into the details of how this $6,000 deduction is going to work. It's for 65 or older. For 2025, you must be 65 by December 31st. The biggest key, if you qualify, this is going to be layered on top of the standard deduction or your itemized deduction if you are going to itemize your taxes. Again, a meaningful benefit if you're managing Social Security and withdrawals from traditional IRAs or 401ks. So here's what this could potentially look like. So if this is a married couple over 65 with $120,000 in income, just as an example, you first could take the standard deduction of $31,500 plus $1,600 for each spouse, $3,200 total, plus that $12,000, $6,000 per spouse, that additional amount. That's a total of $46,700 before any other types of deductions or credits. That's pretty significant. So again, in terms of reducing taxable income, this could be pretty huge. However, again, this bonus, it has a phase out. To avoid any phase out, your income must be less than $75,000 if you're single, or $150,000 if you are joint income married filing jointly. So if your income creeps above those thresholds, again, you may lose some of those benefits. So again, that's why planning ahead is so important. Now, in terms of where these deductions would be fully phased out, the deduction would be fully phased out at income greater than $175,000 for a single filer and $250,000 for married filing jointly. So that's where the $6,000 would completely be gone at that point. And again, this is only going to be in place this year, starting in 2025 through 2028. But over the next few years, again, this could significantly reduce your taxable income, especially for those that are living off of Social Security, pensions, and modest IRA withdrawals. Now, I want to point out a few things that are important to understand about how some of this works. So again, when we're talking about this new $6,000 deduction, it can lower a retiree's taxable income. But when we're talking about things like Medicare and Social Security, what really matters is your modified adjusted gross income, or MAGI. So this is where we get into things like above the line deductions versus below the line deductions, because it's your modified adjusted gross income that determines whether you'll pay IRMAA surcharges, which is that extra monthly premium on Medicare Part B and Part D if your income is high enough. And these new deductions do not change your adjusted gross income. So that's why it's important to model income scenarios if you are retired. That's where it becomes that much more important, because these deductions could provide strategic openings, but it's only going to last for a few years. Now, in terms of Social Security, that's one of the most confusing parts of what this bill offered, because there was some communication from the Social Security Administration that said that up to 88 to 90% of Social Security beneficiaries may not pay tax on their Social Security benefits. But this was not because of the change to how Social Security gets taxed. It was specifically around these new deductions, the age 65 plus deductions, more importantly. So again, didn't change how it gets taxed. It just, because of the additional deduction amount, reduced the amount of people that would be paying tax on Social Security. So it's important to understand your specific situation. It's also important to understand that not every deduction reduces your adjusted gross income. For example, the standard deduction, which is a below the line deduction, does not affect that. But things like retirement account contributions, HSA contributions, certain other adjustments might reduce your adjusted gross income. So just understanding the difference between a below the line deduction and an above the line deduction. Let's talk a little bit about how all these pieces start to connect, because they absolutely do. We just talked through modified adjusted gross income, which is what Medicare uses to determine IRMAA surcharges. Your modified adjusted gross income is going to be more impacted by things like IRA withdrawals, your dividends and capital gains, Roth conversions, even the timing of when you sell an asset, a stock, a piece of real estate. And here's the tricky part. When we're talking about these increased Medicare premiums, as an example, even if you go just $1 over the IRMAA threshold, you can end up paying more for Medicare for the entire year. That's why things like the $6,000 deduction or managing how much income you take can be so powerful. So again, these aren't really just tax tricks. They're tools to protect your retirement income and reduce hidden costs like those Medicare premiums, or even how much of your provisional income, which is what is used to determine how much of your Social Security actually gets taxed. So again, it's really about coordination, not just looking at investment performance, but how your income, your taxes, and your healthcare all start to fit together. All right, so let's talk about how we actually start to use these new deductions in your retirement strategy. And here's just a few ideas you might want to consider. So first thing we look at is potential Roth conversions. If you're in a lower tax bracket this year, we may want to think about accelerating Roth conversions to take advantage of the lower rates with this expanded deduction. You also might utilize what we would call strategic drawdowns. You might consider taking more from your retirement accounts now while you qualify for the deduction to potentially lower future required distributions. You also have something called capital gains harvesting, where you might consider selling highly appreciated assets, especially if you're going to be in the 0% long-term capital gains bracket. For 2025, this is actually less than $96,700 for taxable income for married jointly, $48,350 for single filers. So if you're below that amount of taxable income, you might be able to qualify for 0% capital gain. So again, the opportunity to diversify your portfolio, sell a piece of property, those types of things where you can take advantage of these lower rates as well. Then we talk about RMD timing, so required distributions. If you're not yet required to take RMDs, but expect to be soon, now is the time to start thinking about future withdrawals and how that'll affect your taxes and your Medicare premiums. So again, these aren't all just one size fits all decisions. It really is going to depend on your income, your accounts, your goals. So that's why year-end tax planning is more important than ever this year. So let's shift a little bit to long-term planning. We're thinking about estate strategies, legacy goals, and how this law might affect you as you pass wealth to the next generation. Now, this is one that was in the headlines quite a bit because there was this concerns about what was going to happen with the estate tax exemption. Very few people, quite honestly, are impacted by this, but I think it is important to understand what the new rules are. So the federal estate tax exemption has been increased from $13.61 million to $15 million per person, indexed for inflation going forward, which means that a married couple can now pass up to $30 million federally without paying estate taxes. But I'd like to make this point clear. This doesn't mean estate planning is not important. First, many states, again, we have people joining from all over the country here. Many states still have their own estate or inheritance taxes with much lower exemptions. So you want to understand your specific situation. Second thing is if you own a business, farmland, or highly appreciated real estate, it is actually pretty easy to cross those thresholds over time, especially as the value of real estate has gone up as much as it has over the last few years. Third thing is this could change again. Just as this law raised the exemption, the future administration or Congress could reduce it. And that's why flexibility is really key in your estate plan. So for families with net worth under 15 million, again, this change might feel like very minimal impact on you because you're likely not going to be facing these federal estate taxes. But again, it doesn't mean that having an estate plan, an appropriate estate plan, is not important for you. Because without a plan, you risk your assets going to the wrong people, delays and costs in probate, no protection for heirs that may have special needs or spendthrift tendencies, or credit exposure. And also, if you're remarried, widowed, or you want to leave assets to different children, trust and beneficiary designations become even more important. So yes, this exemption buys you time, may not impact you at all, but it shouldn't mean you shouldn't reevaluate your estate plan, your beneficiary designations at this time. So let's talk a little bit more about gifting strategies. The annual exclusion gift amount is now $19,000 per person in 2025. That means you can gift up to $19,000 to as many people as you like every year with no tax reporting, no gift taxes. You also have the ability to use the full $15 million lifetime exemption. Again, this only makes sense for high net worth situations. Now, if you're worried about future changes to the law, you might want to consider locking in current exemption through lifetime gifts or trusts. And that's really where you want to talk to your estate planning attorneys and develop a plan. And for those charitable goals, strategies like donor advised funds or charitable remainder trusts can allow you to support causes that you care about and reduce your taxable estate or income. So here's, guys, again, kind of a big picture here. Just because the federal exemption is high today doesn't mean it's going to stay that way. We've seen exemptions go up and down before, and it could do that again. Added that we have state level estate taxes with much lower limits. There's things, potential remarriages, blended families, caregiving arrangements, concerns about protecting assets from creditors or nursing homes. So again, an estate plan is not just a set and forget decision. It's definitely something we want to revisit regularly, especially when we have a major change in tax law like we've had this year. Now, finally, if you've thought about leaving a legacy, whether it's the family, faith, philanthropy, now is, again, time to review your plan. But this current law will create some opportunities to capture deductions using donor advised funds, using charitable trusts. So again, looking at where you would like to share wealth or pass wealth down to future generations and understanding what some of those strategies may be under the new tax law. Now, there's also a number of specific deductions and temporary benefits that might impact you or your kids or your grandkids. And I want to run through some of these relatively quickly just so you have an idea of what's out there and determine what might impact you. So let's start with what's called the SALT cap, the state and local tax deduction. So under the old rules, you could only deduct up to $10,000 in state and local income, sales, or property taxes on your federal return. That cap has now been raised to $40,000 for households earning under $500,000. So again, this is especially helpful for those that are living in high tax states like New York, California, Illinois, where property taxes and state income taxes can add up pretty quickly. So if your income was above $500,000, that's where this deduction will start to phase out. But for many retirees living on fixed incomes, this expanded deduction could present more of an opportunity to itemize your taxes going forward. Now, of course, this is going to be one of those that doesn't apply to everyone that's listening, but it could matter for your adult children, your grandchildren who are maybe working hourly jobs. So from 2026 to 2028, tips and overtime wages will be exempt from federal income tax. It's important to understand how these rules work. So that waitress job that your granddaughter might have in college or the overtime your son works in healthcare, that income could be tax-free at the federal level during this window of time. Again, this is a temporary measure, but again, could be very valuable. And it might affect things like financial aid eligibility, Roth contributions for younger workers, even how families save. Now, this one's very specific, but interesting. For vehicles purchased between 2025 and 2028, you can deduct the interest on your auto loan, but only if, number one, the vehicle is assembled in the U.S., and number two, your income is under $100,000. So if you are considering buying a new car in retirement, this may tip the scales towards one of those American-made options. Again, for many retirees, especially those making car purchases out of pocket, this might not apply, but if you are thinking about financing a vehicle through a lower interest rate, this could be a little bit of a win from a tax standpoint. Now, this is going to be a pretty big deal for anyone doing consulting, part-time, freelance work, or running a business while you're in retirement, and that is the Qualified Business Income Deduction, QBI, was originally set to expire, has also now been made permanent. And this is what allows many small businesses and self-employed individuals to deduct up to 20% of their business income. So this applies to sole proprietors, LLCs, S-corps, and partnerships. So if you do any income producing activity like consulting or tutoring, renting out property, this is something you might qualify for. So again, just remember, This deduction comes with rules and income thresholds, so you want to check with your CPA, your tax advisor, to make sure you're optimizing it correctly. And again, I'm going to touch on a few of these that are more business owner related. If you and your family members are small business owners, this might be important to you. The law restores 100% bonus depreciation through 2029, which basically means you can immediately deduct the full cost of qualifying equipment or property in the year that you buy it. So things like vehicles, computers, furniture, or heavy equipment that are used in business, this can actually drastically lower taxable income in the year of purchase, though it also may reduce your depreciation deductions in future years. So for business owners, it's a great opportunity, but again, make sure you're coordinating this with your long-term tax strategy. Again, this one also is a little bit more niche, but still worth knowing. The law reinstates full expensing of domestic R&D, research and design costs, reversing a 2022 change that forced those expenses to be amortized over time. Again, another temporary change through 2029. But if you, your children own a business that involved in product development or software, even biotech, this could make a difference in how they manage their tax liability. Again, even if it doesn't apply to you directly, it's a good reminder that tax changes often have ripple effects across generations and business types. All right, so this is just a few questions you can bring up with your tax advisor, with your financial advisor, as you start thinking about how these things could apply to you. Again, thinking about, should I accelerate certain purchases in 2025 or 2026 to take advantage of bonus depreciation and R&D expensing? If I'm a consultant or self-employed, am I maximizing that QBI deduction? If you're doing things like part-time work or consulting, do they understand how the temporary relief might affect them? Again, tax law isn't just about saving money. It's about using the rules to align your income, your spending, and your investments with your bigger goals. So actually, in addition to tax policy, this new law brings some major changes to social programs like Medicaid, the SNAP program, and Medicare access. Again, these may not affect you personally, but they could impact somebody you care about. So I want to run through these really quickly here. One of the more controversial parts of the new law is the acceleration of Medicaid work requirements. Previously, work requirements were expected to take effect in 2029, but now they're going to begin in 2026. This means that in many states, adults who want to qualify for Medicaid will need to show they're working, training, or volunteering to meet eligibility. So again, why would this matter to you? If you have adult children or relatives relying on Medicaid, they could lose coverage if they don't meet these work rules. It may also increase pressure on you or your family members to help support them if that's a situation you find yourself in. And if you're hoping to use Medicaid to pay for long-term care later in life, again, it's even more important to begin planning now to ensure you qualify under the evolving rules. Now we'll take a look at a couple other programs that are going to be impacted. The SNAP program and Medicare, basically what we used to call food stamps. Parents are now only exempt from the work requirement if their youngest child is under 7. It's pretty significant tightening from prior rules. Again, this will likely reduce access for low-income families and increase demand on food banks and community support programs. For Medicare, the new law limits access for legal immigrants, even those who have paid taxes into the system. Again, could reduce coverage for aging relatives or members of your community who assumed they'd be eligible after contributing over time. Again, these provisions are part of a broader trend, tightening access to income-based aid while expanding benefits for higher earners, retirees, and business owners. All right, so just take a quick step back and talk about some big picture stuff here. These changes may not impact your own day-to-day Medicare benefits right now, but they could affect others. If you're supporting a child who relies on SNAP benefits or Medicaid, they may need some help navigating these new requirements. Some of this is just presenting things that you might be aware of that might impact you, but may also impact people that you care about. Not saying this to alarm you, but just to think proactively on how some of these social programs are changing and whether or not that could impact your own retirement plans. So actually, we've got to understand what the cost of all these changes may be and what that might mean for the future of taxes and benefits. So just kind of talk just briefly about some of the fiscal impact and political outlook around this. Again, trying to stay away from as much political commentary as I can. But again, I think it is important to understand some of these implications. So number one is the cost of these changes. According to the Congressional Budget Office, this new law is projected to add about $2.4 trillion to the national debt over the next decade. And to make room for this, Congress has also approved an increase in the debt ceiling of $4 trillion. That is a huge number. Of course, it raises several important questions. Number one being, how will debt be paid back? Will future tax increases be needed? Could Social Security and Medicare benefits be reduced to help balance the budget? Again, we don't really have the answers to these today, but of course, we do know that long-term planning is more important than ever. As debt rises, tax rates may have to rise as well. And the changes we're discussing today might not be permanent, even if they're labeled that way on paper. Obviously, if there's a change in administration or Congress in 2026 or 2028, some of these provisions could be rolled back, altered, or even maybe replaced. So again, that's why we plan for what we know today, but build flexibility into your financial strategy so you're ready if the rules happen to shift again. All right, so we've covered quite a bit of ground here in a short amount of time. So what can you actually do with this information? We're going to wrap up with just some practical strategies and guidance and next steps. So when you're thinking about what we've covered, tax rates, deductions, Medicare premiums, gifting, even how these changes could affect your kids or grandkids, none of this matters unless you act on it. So let's talk about some of the things you can do now. First thing I would suggest is review your tax projection for 2025 and beyond. Are you in a good tax bracket for Roth conversions? Could this be a year to realize capital gains or maybe accelerate income before some of these changes expire? Second thing would be to evaluate your deductions, your credits, your estate plan. Are you going to qualify for this new $6,000 senior deduction? Are your beneficiary designations and trusts up to date? Are there gifting opportunities you should consider this year? And then finally, the thing you want to do is make sure you have conversations with your advisor, your tax advisor, your financial advisor before year end, so you don't overlook any potential opportunities. Some of these opportunities like Roth conversions or charitable deductions, year-end gifting, they expire when the calendar flips. So you may lose out on those opportunities if you don't take action. So again, you don't want to wait until December when things get rushed or missed. So you want to start thinking about how you can build your plan now while you still have time to be intentional. So here's our final takeaway. Again, this tax law has changed, whether you agree with it or not. What you do next is really what matters. At Blake Wealth Management, we really do believe in being proactive, not reactive. That means making sure we're coordinating your taxes with your investments, looking at how Medicare, IRMAA, and Social Security interact, building a strategy that aligns with your retirement lifestyle, your family needs, and your legacy goals. So we'll continue revisiting your plan, helping you adapt to changes in the law, giving you guidance you need to make confident, informed decisions. For those that are already clients, just know that we are going to be incorporating these changes into our upcoming planning reviews. If you're not currently working with us, but today's presentation has resonated with you, then this next step is going to be for you. As you exit this presentation, you're going to be taken to our Simply Retirement Roadmap page, which is just our simple 3-step process designed to help you make an educated and informed decision about whether we might be the right firm to help you make some of these decisions and navigate these changes, and to put you on the path towards a retirement that's aligned with your goals and your values. Again, whether you choose to work with us or not, we just want to make sure that you walk away with some clarity, not confusion, and confidence in your next financial decision. So as we wrap up, I just want to leave you with one more simple message. The biggest thing you can do is just stay informed and stay proactive. This new tax law does bring opportunities, but only for those that are really paying attention. And I know it can feel overwhelming, but just remember, you don't have to navigate this all alone. So whether it's on how you draw income, how you plan for your taxes, manage your Medicare, or leave a legacy, being proactive now really can put you in more control. And again, that's exactly what we would like to help you, is just help you translate these complex rules into simple, actionable steps that support the retirement that you envision. So again, just be sure you're not waiting until tax season. You can't wait till April in order to take action on some of these. Just taking small steps now can help ensure that your plan is aligned and responsive to what's ahead. Now, a couple of last things regarding free resources. In a follow-up email, you're going to receive 2 free resources that we're going to share with you. You can see the documents on your screen. The first one is going to be our 2025 important numbers, updated for the new tax law. Second thing is going to be the One Big Beautiful Bill Act comparison guide that actually will walk you through what's changing in 2025. As a result of the new law, you'll see where it was and what it's going to be going forward. For current clients, both of these items are going to be included in our meeting agenda for our upcoming planning meetings. Last thing before we get to your questions, one way that we help our clients and our broader community is by staying informed through our Simply Retirement podcast. We talk about everything from Social Security timing to taxes to real life decisions that you may make on an everyday basis. On the screen, you'll see a QR code that takes you directly to the podcast website. Feel free to scan it now or after the session. It's a great way, of course, to keep learning at your own pace and on your own time. That is all we have for the presentation. So we'll get to the Q&A. And again, see how many questions we can get through here in the next little bit. Let's see. And get over there. There we go. Okay. All right. So we can scroll down. We got people just noted California, Texas, Florida. So somebody asked, the first question is, will the recording be available today? Yeah, I got to run it through our compliance folks, of course, and then I'll try to get it posted on YouTube. If you are, I've got a list, of course, of who's registered and who's attended. If you're on our new email newsletter, I'll be including that, which goes out this Thursday. Otherwise, if you want to email me, reach out to me, we can make sure that you get a link to the recording. If we have a large capital gains tax in 2025 from the sale of farmland, how does this affect our income for 2025? Actually, a couple of questions you want to know is what the total capital gain is. Where does that put you as far as your tax brackets? Just knowing that, unless I don't know how big the sale is, but the tax rates for long-term capital gains are 0, 15%, up to 20%. Potentially an extra 3.8% if it puts you above a certain threshold. So you're looking at 23.8%, which could be much less than an ordinary income tax rate. One of the biggest keys with capital gains is understanding the potential impact on Medicare premiums. I touched on that in a couple of different slides. And that is the IRMAA surcharge. Selling an asset like real estate, like farmland that generates capital gains, if it pushes you above those IRMAA thresholds, you will have to pay higher Medicare premiums, not next year, not this year, but in 2027. So your 2025 income or your 2025 tax return will determine what your 2027 IRMAA threshold or Medicare premiums are going to be. And there is nothing you can do about it if it's capital gains. Capital gains is not one of those exceptions that you can use to have that IRMAA surcharge waived. So just be aware of that. And it doesn't mean you're paying tax. You might have to pay extra Medicare premium. Again, not a bad problem to have. You just want to be prepared for it. Any other questions? So far, that's the only question we've got. I'll touch on this, staying away from the political commentary. In terms of the benefits of this new tax bill, obviously, the primary benefit is the continued lower tax rates. We could have seen a pretty significant increase had the Tax Cuts and Jobs Act actually expires and was set to do. So you're thinking about how these tax rates work. For example, the 10% tax bracket was going to stay the same, but the 12 was going to go to the 15, the 22 was going to go to the 25, the 24 is going to bump to the 28. So we could have seen some pretty significant tax rate increases had this bill not put into place. Again, depending on other circumstances that we have to be prepared for. I think the other thing, making these lower tax rates permanent, a positive thing. The new age 65 plus deduction being a positive thing, but just understanding the impact and the short-term nature that it's only going to be for the next 4 years, including 2025. That's where you got to just be aware of your situation and where some of the opportunities may be. So we got a question, is it acceptable to have a tax advisor from a different state that I live in, or would it be advantageous to stay in my state of residence? There's nothing wrong with having somebody in a different state, obviously, as long as they're familiar or have the tools and resources to be aware of the differences in the state that they may reside. So for example, we use a tool that basically allows us to provide tax no matter what state the individual may live in. So it really depends on what their familiarity is with your state or what tools and resources they have available to do accurate tax planning if you happen to live in a different state than they do. Because there can be some pretty significant variations from state to state when we're talking about actually whether it's a state that has state income taxes versus state property taxes or both. That can make a pretty significant difference. Also, in certain states, Social Security is not taxed. Other states it is. So just those little key differences that you want to make sure that they're familiar with or aware of, or have the tools to do proper tax planning for you if you happen to be in a different state than your tax advisor. But in general, not necessarily anything wrong with it. Again, just are they knowledgeable and have the tools and resources? All right. So I read an article that said people are signing up for Social Security sooner to make sure they are in the program before it has cuts. What do you think about that? I think that's probably a mistake to make the decision based on that. That's what I would say first. Because actually that means if you're taking it earlier than you should, or could, that means you're getting a reduced benefit. And actually understanding that they're doing that because they think they might get less later. But here's the reality of the situation. If we think back the last time that we had a significant Social Security change, it was 1983. That's the year that the retirement age was extended to 67, which it is now for anybody born 1960 or later. But if you think about the timing of that, that went into effect in 1983. It took 40 full years for that to fully get implemented into the system, right? So if we're thinking about, okay, if the same scenario plays out and we're 2033 instead of 1983, what could that look like? Most likely, if you're in your 50s and today, you're not going to get impacted. It's going to be the people that are in their maybe their 20s or 30s that are most likely going to get impacted. So making the decision to start early today just because you think they won't be able to change, they won't take your benefits away, I think you're costing yourself because you're taking less than you could have otherwise anyway. So what would be the difference? The other part of that is, again, there's any number of solutions they could incorporate, whether we're talking about changing the cost of living calculations or any number of things that could change. But if like we just said, okay, worst case scenario, nothing gets done. Congress can't come to an agreement and we're now in 2034 and nothing gets done. Basically, they cut benefits by 25%, problem solved. Nobody wants to see that. Nobody wants that to be the final solution. And I don't think it will be. But thinking about your example, so if these people are taking benefits at 62 instead of 67, they're already getting a 25% haircut, actually more, could be around 30%. So what's the benefit? What's the difference? So again, I think it's interesting to see that people would be making that decision. But I think it takes putting some perspective around what's happened in the past and using that as a guide to say that most likely, if you're eligible for Social Security right now, because you're at least 62, the likelihood that you're going to get impacted is very minimal, I would say. Again, it took 40 years to fully implement the most recent full retirement age extension. So what if they do say, okay, well, you're going to take it from 67 to 70? Again, most likely it's going to take 30, 40 years to fully implement that again. So again, it's going to be the people in their 20s today that are going to get impacted, not the people that are already in their 60s. So again, just my thoughts on that. Okay, so we got another really good question. Many accountants seem primarily focused on tax preparation. What is a good way to find an accountant that is focused on tax planning? I think number one, you might want to look at a financial advisor, financial planner, CFP that does tax planning versus an accountant, because you're absolutely right. Doesn't mean all of CPAs and accountants or tax preparers are like this, but in many cases they are focused on tax preparation. So they're looking at what's happened in the past, not always looking at what could happen in the future. So basically just ask that question. What is your process for doing tax planning? What tools or resources? Give you a sample of a report. What are they doing with their existing clients to help them prepare for tax minimization 5 years from now versus just this year or next year? You got to come out and ask the question. But I would also say you might think about consulting with a financial planner who does true tax planning as well. And maybe that's part of your financial team versus just relying on your tax preparer to do your tax planning as well. Because there's also the time aspect. It does take and more time to do tax planning in addition to tax preparation. And that's just doesn't always align with the amount of time they have available. What else we got? Still got time. So we're about almost to the end of the hour, but I'm good to hang around for just a bit. So far, no more questions. Still got a few minutes here. I'm happy to answer any more questions we might have. Awesome. Yeah. Somebody said, thank you for the great explanation for individuals, child credits, and business impacts. Absolutely happy to help. Please give a little more detail on capital gains harvesting. So if you've got a highly appreciated asset, we'll just use, let's say we choose a stock. That's the easiest example. It could be a piece of real estate, anything like that, but something you have a gain on. So let's say you spent $10,000 on a stock and now it's worth $50,000. So you got a $40,000 gain. To actually use that money, to use that $50,000, you got to sell it, which is going to trigger capital gains. So one of the things you might think about is if, again, it always depends on your tax bracket. But if you think about this year with this $12,000 potential up to $12,000 for a couple, both over 65, if that's reducing your taxable income by $12,000 and that brings you to a low enough either ordinary income tax bracket or low enough capital gains bracket, ideally, for example, on capital gains, maybe it puts you down into that 0% capital gains bracket. Well, if I sell some portion of that stock, you don't necessarily have to sell it all. But if I spent $10,000 and it's worth 50, I've got a $40,000 gain. Maybe I sell some portion of that to put me at the top of that 0% long-term capital gain bracket in order to say, okay, when I sell it, I basically don't pay any tax on that money because I'm and again, low enough tax bracket to do so. So that's basically what we're talking about when we talk about capital gains harvesting is intentionally selling an asset because I know I'm going to be at a lower tax bracket than I might be in the future. That's really what it comes down to. And now it could also be the other way to think about that would be maybe if you have losses, a loss carry forward from selling some other asset or some other investment at a loss in the past. So you get to take up to $3,000 in the current year to reduce your ordinary income. But if you sold an asset and you took a $10,000 loss, you got to use that over 3,000 per year until you use it up. Or if I've got a loss carry forward and I sell something at a gain, I can then use those to offset, which again minimizes your taxes. So the question is regarding tax planning, do you mean to find a CFP that is also an accountant or a CFP like yourself who's very knowledgeable about taxes? I mean, it's either or. There are, for example, we are potentially going to be adding tax preparation to our services next year. Still some details to work out there. So that could be it, where you just find a financial planner that also does tax preparation. Doesn't change the fact that you want to ask them, okay, what does tax planning mean to you? What tools, what resources? Can you give me an example of what a tax plan might look like, a tax projection over the next 5 years? The question is really the same, but for you, it depends on if you need somebody that's going to prepare your taxes and you have confidence in that person, you might stick with your tax preparer, but then yes, engage with a CFP or a financial planner who does the tax planning piece. So it really comes down to the questions you ask and making sure you feel confident in their ability to do the tax planning. Hopefully that makes sense. I'm not sure I explained that the way I wanted it to, but basically you could find a CFP that does tax planning. So regardless if that CFP does tax preparation or not, you still got to make sure that you feel confident in their ability to do tax planning, or that is a service that they offer and that you understand what that looks like. So we're talking about doing not only tax projection for 2025, but what could be 6, 27, 28, 29. What do these future years look like? Knowing that, again, we're just making our best educated guess, but you still want to outline a game plan for what you can do to reduce your lifetime tax liability. All right. Any more questions? Yeah. So the question is, would you have a sample tax plan that you could share with us? I got to be a little bit careful of that with tax planning because actually each individual is different and you got tax advisors staying away from giving specific tax planning advice without knowing the entire situation. But I would say reach out directly if you feel comfortable with that. Shoot me an email, eric@blakewealthmanagement.com, and I can send you something, what that might look like, just a sample plan directly versus sharing it across the board. You just got to be, when it comes to taxes, you always have to be a little bit careful about sharing it on a wide ranging basis. But feel free to email me and we can talk about that more, what kind of examples you might be looking for. All right, how are we doing on numbers? So we still got a decent number of people. Oh, screen sharing has stopped. That's okay. Right. All right. So tell you what we're going to do. If you got any more questions, we'll wrap up here pretty quickly. I'm going to follow up with an email. So feel free to reply back to that if you've got additional questions. Since there's so much to think about throughout the year, is there an annual outline you could share on what to think about when? So number one, I'm going to be sharing the 2025 important numbers. So that's going to give you the current year tax brackets, the standard deduction numbers that you saw. It's going to give you Social Security numbers to be aware of. It's also going to give you, the second piece was the tax law comparison to show you, here's what it would have looked like. Here's what it is now. So I'm going to send both of those documents. So that's going to give you a pretty good assessment for 2025. Before I send that email out, I know I've got a couple of resources that are kind of timeline checklists. I do have one that is a I actually recorded a podcast episode today, as a matter of fact, on year-end tax planning checklist. And so I've got a what should I be considering at the end of the year that I could probably send out as well. But that would be a really good one to work through the remainder of the year. And I do have a couple others that might fit. Again, feel free to reach out to me directly, and I'd be happy to share a couple of resources that may be helpful for you. All right. Anything else? All right. So tell you what, like I said, so anybody that's still hanging on with us, I'm going to follow up with an email. I'm going to include those free resources that I shared during the presentation. I'll get those to you. If you have more questions, don't hesitate to reach out, shoot me an email, reach out in any way. Happy to help. And know there's a lot to think about, a lot of different moving parts to be aware of, and how this is going to change things for many people. So again, feel free to use this as a resource. Look forward to hopefully connecting with some of you here in the near future. If I can do anything, please let me know. Be sure to, again, check out the podcast. A lot of these topics that we've addressed here. Right now, we've got a series on the widow's penalty, some of the challenges that widows face after losing a spouse from an income standpoint, a tax standpoint. Also, tomorrow, our new episode is going to be a 3-part series on navigating loss, basically what to do the first week, the first month, and the first year after losing a spouse. Some of these things that just from an emotional standpoint, you're just not ready to deal with, but unfortunately, they come pretty quickly. So just how do you navigate those issues? But again, a lot of these topics filter into, from a tax standpoint, taxes are always part of that conversation. So that's what I would probably suggest is, again, tune into the podcast. We cover a lot of these issues. But again, feel free to reach out to me directly if there's anything I can do to help. Hope you guys have an amazing evening. Thank you so much again for joining, and best of luck going forward.